Today we're analyzing Novo Nordisk. The ticker is NVO. Here's the 5-year chart. They're up 428% in the past 5 years, basically in a straight line. So that is pretty cool, pretty awesome. Their market capitalization right now is 600 billion. Huge company. The price to earnings ratio is a bit steep at 48, so let's see if they have growth to back it up. And their dividend, they have a dividend of less than 1%. Doesn't really make too much of a difference there. Let's check out their numbers here. Go into the financial statements and let's see what their revenue growth, I guess, is looking like. Looks like they've got positive revenue growth every single year. And we can see plus 2%, so not very good back here, but then it starts to pick up after COVID, plus 15%, plus 10, and then plus 34% last year. And it's probably due to their new GLP-1 drugs that they have come out with. Let's check yeah, their net income follows pretty close with their revenue as well. Let's check their balance sheet. Most recent quarter, they have a net debt of they basically don't have any debt. They have enough cash to pay off their total debt, so really solid balance sheet there. Let's check out the cash flow. Cash flow follows their earnings very closely. Let's check out the stats. We're going to look for here is the ROIC, very high ROIC, which is always good to see. And then the net margin at about 32 to 35%. Let's okay, now I want to go to their investor slides. Here is their, let me zoom out for a second. Okay, this is their pipeline. Pretty impossible to read. I don't really put too much faith into the pipelines. They make most of their money from obesity drugs and diabetes, actually. So they make a lot of money off of diabetes, and diabetes isn't going to go away anytime soon. Let's see exactly what their segments look like. So this is their diabetes market share and GLP-1 market share. GLP-1 on top, and then we've got their insulin sales are in the middle, and their total diabetes market share is 33.8%. Their total diabetes sales has increased by 29% last year, and like I said, that is most of their sales. We can see here in this graph, I want you to focus on the dark blue is going to be their diabetes care, and then the light blue is obesity care, and then the rest is rare disease. Rare disease makes up very little of their revenue. It's mostly obesity and diabetes. That's what I want you to take away from this. And their operating profit has remained steady at about 40% as well. Next slide. This is a further breakdown of where they get their money. They get most of it from this drug called Ozempic. Not quite sure what that is for. It's mostly for diabetes and obesity, I guess. And then we've got Rybelsus and Victoza. Those make up their GLP-1 drugs. And then we've got their insulin drugs, which are all of these: long-acting insulin, premix insulin, fast-acting insulin. And that makes up another big chunk of their revenue. And then we have Wegovy, which is the new one, and Saxenda. Wegovy is just a very small amount of their total revenue right now, but maybe that will grow into a bigger segment. We'll see. So I have their estimates. So I have estimates from the Yahoo page, and we have $3.38 per share is the earnings estimate for next year, and then $4 a share for the year after that. Then the revenue estimate is $42 billion for next year, and then 50 billion, or it's about an 18% increase into 2025. So I put these numbers into a discounted cash flow model. Let's check that out. And here we go. So I put their market cap here, almost 600 billion, right? 587 billion. price of 133 gets me the shares. We put the EPS estimate and the revenue estimate for next year. They said they're going to do about $3 billion in buybacks. Their net debt is negative, so we put that in there. Discount rate of 10% because I want 10% on my money. Exit multiple of 20. I think that is fair for a pharmaceutical company because they usually have pretty consistent earnings. Then we have our discounted earnings model. So I put the next year's earnings growth as 18%, and then after that, dropping off just slightly to 15%, and then 12 and 10. It's possible that competitors come in with other drugs, so I want to be conservative with their growth estimates. Maybe they could do better than this, but remember earlier in their years, they had years where they only grew by like 2 or 3% in their revenue. So I do feel like this is a fairly accurate judgment in growth. Same with their revenue growth. Revenue growth of 18% predicted next year, and then slowing down from there to 15, 12, 8, and then down to 5, because they did have years where they grew only by like 2 or 3%. So I think 5% is still generous. Then we have profit margin, and their profit margin has always been about 35%. Maybe we could say that it expands, but also there is going to be competition coming into the space with Eli Lilly and their new GLP-1 drug. So I don't want to hype up the profit margin too much. I think 35% all the way across is perfect, and it gives us a fair value of $89 and $85 compared to the price of 133. We are quite a bit. Well, the price right now is 50% over the fair share price. So let's see what type of returns you could expect if you bought them today. Right now we're doing a discount rate of 10%. Maybe we go to 8%, and it looks like we're not quite there. Let's try a 5%. 5% gets us really close. How about 4%? Okay, 4% gets us very, very close. So I would say that if you bought them today, you'd be expecting a 4% return moving forward, which is less than bonds, but they could outperform this estimate, but it's also possible that they underperform. So if you guys have any questions about the spreadsheet, just leave them in the comments. I also put a link in the description so you guys can play around with this model yourself. Otherwise, that's it for me. See you in the next one.